guys? Welcome to the Everything Money 24/7 channel. We've got this week of earnings coming out. And of course, everybody's going to focus on this one right here. I don't know if you guys have heard of a company called Nvidia. They've been killing it the last 2 years. They've been leading the artificial intelligence processor space, as they say. So guys, everybody's going to be watching this one. This is a company with frothy valuations, but of course, every investment is the present value of all future cash flows. So the future cash flows that are being assumed today are a lot lower than what they'll be in the future. Nvidia could still be a buy. Does that make it probable? I don't know. For me, the upside's probably not worth that risk, but everybody's gonna be watching Nvidia this week to see what's going on. Some of the companies I'll be watching for: Best Buy reports on Thursday. Ulta, which I own, but you should not own a stock just because I own it or anyone else on the internet, or even Warren Buffett owns it. But these two will tell me a lot about consumers. We said in past videos, Target reported same-store sales decline. Home Depot reported same-store sales decline. Lowe's did the same thing. Ulta still had an increase in same-store sales, but a declining rate. This is going to tell us a lot about consumers because you know who crushed it? Walmart. So it told me that the consumer is being a little bit more cautious than people want to understand. Now, if you're new to this channel, this is a channel dedicated to doing earnings releases, information on the market. The Fed is going to be very important here soon for a lot of people's perception of what's going on out there. So do me a favor. If you like updated news, follow us, subscribe to this channel, get on that. And if you like chatting on the interweb, I am EM Paul G on Twitter. Follow me there on X. And I think it's right here because I like to get very active. I like to talk a lot about what's going on in the economy. This is not about fudster, guys. It's not about being a fudster. This is about talking about what these data points mean. And guess what? Probably 98% of the data out there is absolute garbage you don't need to worry about. Even if we're in a recession, the goal here is to talk about where can we find good value. Recessions are a great place to be. Why? Because stock prices tend to fall during them. And when stock prices fall, you should want to buy more shares of them, right? That's very, very important. Ulta skyrocketed from $320 a share to like $380. Why? Because Berkshire Hathaway bought some shares. Does that make it a good company or not? I don't know. Lululemon's reporting, another consumer, but expensive consumer product. So you're going to want to see, how do they report? Do they beat expectations? Do they not beat? This is an area where I actually will look at expectations because the expectations are come out a year ago, 6 months, 3 months ago. So as time goes on, are those expectations being decreased? And then when it finally comes out, are they beating those expectations? Okay. Now, Ollie's is a discount store. So are their shares going up? Sorry, are their same-store sales going up? These are the things that matter. Affirm does a lot of lending. Are they seeing delinquencies increase? These are all the things that to look at. But remember, we also have Kohl's here, another discount consumer store where people can get a lot of values. And Kirk Cousins loves going to Kohl's, even though he makes $1 billion a year. But remember, guys, this is all short-term stuff. I don't care about the short term. What I care about is finding cheap companies relative to their future propositions. Remember, and it's always funny that the one area in the world that people dislike discounts on is the stock market. But we're trying to change that narrative for you. That's why I want you to subscribe to this channel. If you want to get to the point in your life where you look at stocks and you look at businesses and say, how do I look at this thing from a 10-year perspective? You know, it's interesting. When I'm on Twitter, I always see people saying, I'm a long-term investor and my stocks are up 0.6% today. I don't even look at my stocks. If you ask me today what stocks, I have no clue. Why? Because I bought companies that I think will be around for a very long time and will have a higher revenue and profit in the future than they do today. But more importantly, I bought them at prices that made sense today based on that future assumptions with the proper margin of safety. I want you to have that same mentality. Now, obviously, where does that go to? Well, where do we stand today? Guys, every week I try to disclose this. This is my stock market to GDP, as well as my 10-year cyclically adjusted PE ratio where the market stands at any given time. Warren Buffett, this is the Warren Buffett indicator. I made it going back to 1928. We're currently at 1.97 ratio, which is 110% overvalued. 110% overvalued. We got as low as 48% overvalued back in September of 2022 after we had the big drop, the big bear market that we had. I put big in quotes actually back in 2022, and we went right back up from there. Okay, now a lot of people argue this metric doesn't matter. Guess what? I heard it in 2006 and 7. I heard it in 1999, 2000. You hear it every time we see a bunch of high-flying stocks killing it, like the FANG stocks. Anyone remember FANG? Anyone remember FANG? Now it's the Mag 7, and guess what, guys? It'll be something else in the future. Just like before it was EV, cannabis, all these things, as time goes on, it's now AI. It'll be something different in the future. That's what I want you to remember and understand. So unless you're able to predict trends, which I don't really think many people are able to do, find good companies that'll be around for a long period of time that you can pay reasonable prices for. Now, the 10-year cyclically adjusted PE ratio. This is taking the last 10 years of earnings in the S&P, normalizing it to today's dollars using inflation. And we're currently at 36.34, which is 112% overvalued. So for those of you who think that the stock market GDP ratio isn't realistic, this is actually worse. And it doesn't care where the earnings are given. And I forgot to change this date to August 26th. But I look at this saying, guys, fair value on the S&P is about 2650 based on this. And it's about 2693 based on the stock market GDP ratio. And based on a 1.97 ratio, if you go right here, we're at 2. We're looking at negative returns on the S&P, not including dividends. You look at history, when we've been around this area, we've never had positive. Well, we had a little bit of positivity right here, but it was barely positive. So what this tells me is the next 5 or 10 years are probably not going to be as good as the last 5 or 10. But that's an opportunity for you, for people who dollar cost average. When you dollar cost average and the market goes like this over long periods of time, but the price goes like this, you don't have to worry about where valuations are. You just buy along the way, and you buy when it's high, you buy when it's low, and over time, you pay about the average. That's what's wonderful about dollar cost averaging. And for those of you who like to buy individual stocks, as long as you buy good companies, the hard part is when prices fall, news will follow that, and people will hate it. And then your job is to determine what information really matters in that. That's what's so key here, guys. This is not rocket science. The hardest part about investing is here. Do you have the stomach to invest? It's not about the numbers. Yeah, the numbers do matter, but we can all determine the numbers. The question is, can you look at a stock falling and saying, you know, I like this company still. I think the news is more negative. That's a hard thing for the vast majority of people to do. It was hard for me to do a long time ago, but over time, I brainwashed myself. I got myself in a new paradigm shift that I'm trying to get everybody else into. If you're able to change that mentality, you're going to do very well in investing. And that starts by immersing yourself in these videos very regularly, every week, every day. Repeat the same things over and over to yourself. That's how you get better at this. Guys, 2 things. Subscribe to the channel. Follow me on Twitter at EMPaulG. Thank you very much for your time. We'll see you later.